A staggering 9.114% real equity return per year. That is the massive alpha investors were pulling during the first decade of the 1800s. We're talking about a fiercely lucrative bull market driven by an absolutely incredible global arbitrage opportunity, the neutral trade. Understanding exactly how this unprecedented liquidity flooded the early American economy gives us the ultimate blueprint for how volatile, unregulated capital markets operate and exactly how they crash. Just look at this real equity return, 9.14% annually from 1800 to 1809. Now, you might be wondering, was this organic, domestic growth? No way. This was American merchants relentlessly exploiting global Napoleonic warfare. With Britain and France locked in total economic attrition, the United States stayed strictly neutral. That genius geopolitical positioning allowed American ships to become the primary carriers between Europe and the Caribbean. You just load up sugar and coffee, neutralize the cargo in U.S. ports, and re-export it to Europe at massive premiums. The result was an absolute tidal wave of cash. Total U.S. re-exports skyrocketed from just $1 million in 1792 to nearly $40 million by the year 1800. Think about that for a second. We are talking about a 40x expansion in a single niche sector in under a decade. This created deep, heavy pools of domestic capital, all desperately looking for yield. And because the young republic already had a surprisingly developed banking infrastructure, this merchant fortune didn't just sit idle in vaults. It was weaponized into speculative equity. Wall Street's first trading floor. So where exactly was all this explosive liquidity being parked? Well, it flowed directly into Wall Street's literal first trading floor, the totally unregulated, highly chaotic hub right at 88 Wall Street. This wasn't some quiet digital exchange with flashing screens. English traveler John Lambert captured the frenzied energy perfectly in 1807, describing a classless hub packed with underwriters, brokers, and politicians. Auctioneers were literally standing on hogsheads of sugar and bales of cotton, shouting out bids. It was a combination club, clearinghouse, and auction block operating in a total regulatory vacuum. Fistfights routinely broke out on the steps between political factions. This was raw, unfiltered price discovery at its core. When we look at the sectoral concentration in the GFD 100 index, early bank stocks and marine insurance completely dominated market capitalization. But keep in mind, these weren't standard tech startups or consumer goods companies competing on a level playing field. These commercial bank charters were essentially bitter, corrupt political favors. State legislatures rationed out charters as partisan patronage, locking out competitors and triggering intense bribery scandals just to get a company off the ground. For retail investors who are priced out of those political banking monopolies, there were alternative plays. Early infrastructure corporations, turnpikes and toll bridges. State legislatures empowered private joint stock companies to build graded roads and actually collect tolls. And let me tell you, they were wildly lucrative. Boston's Charles River Bridge generated a massive 10.5% average annual return in its first 6 years alone. These were highly sought-after, tangible assets generating real, consistent cash flow for investors. The Louisiana Purchase arbitrage. In 1803, the market gets hit with the ultimate macro catalyst. We really have to stop looking at the Louisiana Purchase as just a simple historical land deal. From a market perspective, this was an enormous $15 million leveraged buyout. Let's break down the complex underwriting mechanics here. The U.S. Treasury simply didn't have the cash to buy this territory from Napoleon, and the domestic markets were way too small to absorb the debt. So the government structured a complex, multi-layered deal with Europe's preeminent merchant bankers, Baring Brothers and Hope & Co. The U.S. assumed $3.75 million in private merchant debt, and the remaining $11.25 million was structured as a direct bond issuance to France. The absolutely crucial point is the underlying security created by this deal. These were newly minted U.S. government bonds bearing a solid 6% interest rate. This became one of the earliest U.S. securities to be actively marketed and widely traded on the international stage. But here's the catch. Napoleon didn't want a 15-year amortizing bond. He needed immediate, liquid cash to fund his wars. And that desperate urgency allowed the banking consortium to step in and secure an incredibly aggressive pricing structure. The bankers bought the entire bond issue from the French Treasury at a steep 13.33% discount. They effectively paid France 86.5 cents on the dollar, fronted the cash, absorbed massive liability relative to their capital, and immediately pre-sold that risk to the European public. And right here is where we see the jarring geopolitical contradictions of the era. You had Baring Brothers, a premier British bank, spending the next 2 years sending millions of francs directly to the French treasury. They were literally funding Napoleon's war against Great Britain itself. Why? Because the British government tacitly approved it to permanently remove the French military threat from North America. It was the ultimate global arbitrage. The Embargo Act crash. But as we know, geopolitical arbitrage cuts both ways. The market's absolute reliance on European warfare set the exact stage for a devastating Black Swan event in 1807 when the British attacked the American USS Chesapeake, triggering a catastrophic federal policy response. On December 22, 1807, President Jefferson and Congress passed the Embargo Act. It was an unprecedented shock to the system. The federal government intentionally outlawed all American merchant ships from leaving for foreign ports. Overnight, they legally severed the primary artery of the national economy. Look at the sheer scale of this vicious, self-inflicted crash. Pre-embargo exports sat at a high of $108 million. Post-embargo, that collapsed to just $22 million. The shipping industry was completely wiped out. Agricultural surpluses just rotted on the docks. Treasury revenues completely dried up. This wasn't a standard market correction. This was America's first major economic depression. And the retail portfolio impact? It was immediate and brutal. Merchants, stripped of foreign exchange, defaulted in record numbers. Overextended state banks suddenly realized they couldn't redeem their paper notes for gold and silver. Bank directors desperately stalled customers, offering redemptions at steep discounts. This destroyed public confidence entirely, sparking severe bank runs and massive currency depreciation across New England. The Yazoo land fraud. Now, while northern banks collapsed, the system grappled with something even darker. The total lack of regulatory oversight fostered the perfect environment for the very first major corporate fraud to hit these speculative markets. The sheer scale of this fraud is mind-bending. In 1795, the Georgia legislature transferred 35 million acres of Western territory to 4 speculative land companies for just $500,000. To put that in perspective, that is 1.4 cents per acre. How did they pull this off? Through systematic, brazen bribery. Speculators distributed cash and company shares to almost every single member of the state legislature just to secure the deal. Of course, when the public found out, a newly elected reformist government passed the 1796 Rescinding Act, voiding the corrupt contracts and literally burning the physical bills in the streets. But there was a massive structural problem. The original corrupt land companies had already flipped millions of acres to third-party northern capitalists. These speculators claimed they'd bought the land titles in good faith, completely unaware of the original bribery. It created an absolute legal and political gridlock that dragged on for years. This gridlock forced a defining structural payoff for American markets. A collusive lawsuit was pushed all the way to the Supreme Court. In 1810, Chief Justice John Marshall issued the Fletcher v. Peck ruling. Marshall ruled that the state's Rescinding Act was unconstitutional. He established that a contract, even a spectacularly corrupt one procured by blatant bribery, was legally binding once executed and resold to innocent third parties. It was a shocking ruling that effectively laid the ironclad foundation for modern American corporate law and the sanctity of the contract. So, from 9% risk-free returns off global war, to a $15 million leveraged territory buyout, to a totally self-inflicted depression and legalized corporate fraud, the absolute foundations of the market were set in extreme structural volatility. So looking at capital flows today, ask yourself, if a market's entire liquidity structure is built on unregulated political favors and geopolitical arbitrage, is a catastrophic crash simply inevitable? How are you positioning your own portfolios for these exact kinds of black swan events? Let's debate it down in the comments.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.